Let's understand stock indices and their role in financial markets. Stock indices are statistical measures that track the performance of a group of stocks, representing a specific market or segment. Indices combine multiple individual stocks into a single measurement. They provide a simplified way to measure the overall performance of a market or sector. Stock indices serve as benchmarks for investors to gauge market performance. They allow investors to compare their investment returns against the broader market. Here we see how a typical portfolio might perform against a market index over time. Indices are calculated using different methodologies. The three most common methods are market capitalization weighted, price weighted, and equal weighted. Market capitalization weighted indices give more influence to larger companies. Price-weighted indices are influenced more by stocks with higher share prices. Equal-weighted indices give each component the same influence regardless of size or price. Indices provide a snapshot of market trends and economic health. They allow investors to monitor overall market movements without tracking individual stocks. As we can see, indices reflect different economic phases like growth, recession, and recovery. To summarize, stock indices are essential tools that track the performance of stock groups, serve as benchmarks, and help investors monitor market trends. They use various calculation methods and provide invaluable insights into market health without the need to track individual stocks. The S&P 500 is widely considered the best gauge of large-cap U.S. equities. It includes 500 leading companies covering approximately 80% of available U.S. market capitalization. Created in 1957, the S&P 500 has become the most widely followed equity index. Unlike some other indices, the S&P 500 is market cap weighted, meaning larger companies have greater influence on its performance. The index is managed by S&P Dow Jones Indices, which maintains strict criteria for inclusion. The S&P 500 is a market cap-weighted index, which means companies with larger market capitalizations have greater influence on the index's performance. For example, a 1% change in a trillion-dollar company like Apple has a much greater impact on the index than the same percentage change in a smaller company. This is in contrast to price-weighted indices like the Dow Jones Industrial Average, where companies with higher share prices have greater influence regardless of their total market value. Since its creation in 1957, the S&P 500 has shown remarkable growth, though with several significant downturns along the way. Starting with a base value of approximately 50 points in 1957, the index has grown to over 4,500 points by 2023, representing the tremendous growth of the U.S. economy. To be included in the S&P 500, companies must meet specific criteria established by the Index Committee. The market capitalization requirement is currently over $8.2 billion, making the S&P 500 truly a large-cap index. Companies must also demonstrate profitability, with positive earnings in the most recent quarter and over the trailing 4 quarters combined. Additional requirements include adequate trading liquidity and at least 10% of shares available for public trading. Finally, companies must be headquartered in the United States to be eligible for inclusion. The S&P 500 is maintained through a process of quarterly rebalancing in March, June, September, and December. During these reviews, companies can be added or removed based on whether they continue to meet the index criteria or due to major corporate events such as mergers or bankruptcies. The S&P 500 serves as the basis for numerous investment products that allow investors to gain exposure to the broad U.S. market. These include exchange-traded funds, index mutual funds, futures contracts, and options, collectively representing trillions of dollars tracking the index. The Dow Jones Industrial Average is one of the oldest and most recognized stock indices globally. Founded in 1896 by Charles Dow, the index has evolved significantly over its long history. The Dow began with just 12 stocks, expanded to 20 in 1916, and reached its current size of 30 stocks in 1928. In 1997, the index included its first non-U.S. company, and it continues to evolve with regular composition changes. The Dow Jones Industrial Average tracks 30 large blue-chip companies across various sectors of the U.S. economy. Despite having industrial in its name, the index now includes companies from diverse sectors like technology, healthcare, and consumer goods. Unlike most modern indices, the Dow Jones Industrial Average uses a price-weighted methodology. This means that stocks with higher share prices have more influence on the index, regardless of the company's total market value. For example, a company with a $300 share price would have twice the impact on the Dow as a company with a $150 share price, even if the second company is twice as large in terms of market capitalization. The Dow Jones Industrial Average is calculated by summing the prices of all 30 component stocks and dividing by the Dow divisor. First, we add up the current price of each stock in the index. Then we divide this sum by the Dow divisor, which is currently around 0.15172752. This divisor is adjusted to maintain continuity when there are stock splits or changes in the index composition. Looking at the Dow's historical performance, we can see the index has experienced significant growth, but also notable volatility. Major events like the dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic caused sharp declines, but the index has generally trended upward over time. Several key events have shaped the Dow's trajectory over the years, including market crashes and economic downturns. To summarize, the Dow Jones Industrial Average is a classic index with significant historical importance. While its price-weighted methodology and limited number of components have drawbacks compared to broader indices, it remains one of the most recognized market barometers worldwide. The Nasdaq Composite tracks approximately 3,000 stocks listed on the Nasdaq Stock Exchange. Created in 1971, it's a market cap-weighted index with a heavy concentration in technology companies. The index is widely recognized as the barometer for the technology sector. The Nasdaq's sector composition shows its heavy technology weighting, which accounts for approximately half of the index. This technology concentration makes the Nasdaq Composite more volatile than other major indices like the S&P 500 or Dow Jones Industrial Average. Looking at the Nasdaq's historical performance, we can see significant volatility, including the dot-com bubble in 2000 and the financial crisis in 2009. The Nasdaq 100, a subset tracking the 100 largest non-financial companies on the exchange, is also widely followed. It forms the basis for the popular QQQ ETF, one of the most actively traded exchange-traded funds worldwide. Stock indices serve multiple purposes for different types of investors. Investors use indices as benchmarks to measure their portfolio performance against the broader market. Index funds and ETFs allow investors to gain exposure to entire markets by tracking the composition of indices. Economists and policymakers monitor indices as indicators of overall market and economic health. Indices serve as underlying assets for derivatives like futures and options contracts. Investors follow different strategies when using indices as reference points. Passive investing aims to match index returns rather than beat them. This approach features lower fees, minimal trading, and a long-term investment horizon. Active managers, on the other hand, try to outperform indices through security selection and market timing, typically incurring higher fees and more frequent trading. Technical analysts study index movements to identify market trends and potential turning points. They look for patterns like support and resistance levels, which can signal potential price floors and ceilings. These analysts use various techniques to interpret index movements, including trend identification, momentum indicators, and pattern recognition. Indices also serve as underlying assets for various derivative products. Index futures allow investors to speculate on future index levels or hedge existing positions. Index options provide the right, but not obligation, to buy or sell an index at a specified price. Index swaps let counterparties exchange cash flows based on the performance of an index. When companies are added to major stock indices, they typically experience a significant stock price boost. This chart demonstrates what's known as the index effect. Before the announcement, the stock typically trades normally. When inclusion is announced, there's usually an immediate price jump due to increased demand from index funds and ETFs that must purchase shares to maintain accurate tracking. Let's examine the specific requirements for inclusion in each major index. The S&P 500 has specific quantitative requirements for inclusion. Companies must demonstrate financial viability with positive earnings for the most recent quarter and the sum of the last 4 quarters. Companies need a market capitalization of at least $8.2 billion, though this threshold is adjusted periodically based on overall market conditions. Liquidity is also critical. At least 50% of shares must be available for public trading, with monthly trading volume of at least 250,000 shares. Even when all criteria are met, final decisions are made by the S&P Dow Jones Indices Committee, which considers additional factors. Now let's look at the Dow Jones Industrial Average, which has a more subjective selection process. The Dow Jones Industrial Average selection process is more subjective than other indices. Companies are chosen by a committee rather than purely quantitative metrics. The selection committee focuses on company reputation, demonstrated growth, and ensuring proper sector representation across the index. Unlike the S&P 500, there are no specific size requirements, though included companies tend to be large cap. Finally, let's examine the Nasdaq Composite Index inclusion requirements. The Nasdaq Composite has simpler inclusion criteria. Companies primarily need to be exclusively listed on the Nasdaq exchange and meet its listing requirements. These requirements include minimum stockholders' equity, maintaining a share price of at least $4, and having a minimum number of shareholders to ensure adequate market liquidity. Regardless of which index a company joins, inclusion typically results in increased visibility, trading volume, and often a sustained boost in stock price due to ongoing demand from index tracking funds. As we've seen, index inclusion requirements vary widely, but the benefits to companies are significant across all major indices. Comparing the historical performance of major stock indices reveals distinct patterns based on their composition. Let's examine how the Nasdaq Composite, S&P 500, and Dow Jones Industrial Average have performed over the past decade, from 2013 to 2023. Over this period, we can see that the Nasdaq Composite has significantly outperformed both the S&P 500 and the Dow Jones. This chart shows index values normalized to 100 in 2013. By 2023, the Nasdaq had grown to approximately 330, while the S&P 500 reached 230, and the Dow Jones about 200. We can identify several significant periods that shaped this performance. From 2017 to 2020, a tech boom strongly benefited the Nasdaq. The 2020 market crash affected all indices, but the Dow Jones showed more stability, declining less dramatically than the tech-heavy Nasdaq. During the subsequent recovery, the Nasdaq and S&P 500 rebounded more strongly than the Dow, reflecting continued strength in growth-oriented sectors. Several key observations emerge from this comparison. The Nasdaq's technology concentration drove its superior performance during this period of tech dominance. These performance differences can be explained by the sector composition of each index. The Nasdaq is heavily weighted toward technology and communication services. The S&P 500 has a more balanced composition, but still significant technology exposure, while the Dow Jones contains more traditional industrial and financial stocks. Each index responds differently to economic cycles based on these sector weightings. Tech-heavy indices tend to outperform in growth-oriented markets, but may experience more volatility in downturns. Over the very long term, the S&P 500 has delivered average annual returns of approximately 10%, though performance varies significantly across different time periods. Index investing offers simplified ways to gain diversified market exposure through ETFs and index funds. Exchange-traded funds, or ETFs, and index funds are investment vehicles that hold a basket of securities matching a specific index, like the S&P 500. Here are some of the most popular ETFs for different market indices. For S&P 500 exposure, investors often choose SPY with a 0.09% expense ratio or VO and IVV, both with just 0.03% annual fees. For Dow Jones exposure, DIA is the primary ETF with a 0.16% expense ratio, while the Invesco QQQ Trust offers exposure to the Nasdaq 100 index at 0.20%. Index investing offers three key advantages: low costs, with expense ratios as low as 0.03% compared to 1% or more for actively managed funds; tax efficiency through lower portfolio turnover; and instant diversification across hundreds of companies. These advantages have driven dramatic growth in passive investing. Since 2000, the share of U.S. equity fund assets in passive strategies has more than tripled, now exceeding 40% of all U.S. equity fund assets. The future of stock indices is evolving rapidly, with several key trends shaping how they will function in the coming years. One major trend is the increased focus on ESG factors, environmental, social, and governance metrics. Traditional indices are now being screened through ESG filters to create sustainable variants that prioritize companies meeting specific environmental and social standards. Custom and thematic indices are growing significantly in popularity. These specialized indices target specific sectors like clean energy, cybersecurity, artificial intelligence, and fintech. The growth trajectory for thematic indices has been steep, and projections suggest continued expansion as investors seek exposure to emerging technologies and industries. Technological advancements are enabling real-time index calculation and more sophisticated methodologies. Artificial intelligence is being used to develop new weighting approaches, while blockchain technology offers greater transparency. As market structures change with the rise of private equity and alternative investments, indices will need to adapt to capture broader market representation. Future indices may incorporate private market assets, digital currencies, and other alternatives that currently aren't represented in traditional public equity indices. This evolution of stock indices will fundamentally change how we measure and track market performance in the coming decades.